to an extent, there is still a need to create an awareness about this particular law, because that seems to be more followed in breach rather than in compliance. The history, of course, goes back to 1976, prior to which it is the Yashwantrao Chavan, if my memory goes correct, in 1969, who had on the floor of House expressed a concern about the influence of foreign funds on the functioning of the government, political parties and other institutions. And it is as a result of that concern which was expressed, we got a law in 1976, which was one of the worst laws, I would call it as, in terms of the language as well as in terms of implementation. But object-wise, it was in the national interest, and it went on, I think, since 76 till 2010. And in 2006, of course, they came out with a bill to replace, having realized, like they realized in FERA, that FERA was one of the draconian law, which was more followed in terms of breach rather than in compliance. The same was the result with FCRA. They came out with the new law in 2010, which is, of course, a modified version of the draconian law, as I would call it as. And therefore, there is a need to at least understand the implications of this law, which affects large number of people, including the charitable trust. And in charity, the difficulty is, when I was doing my articleship in almost in the early 70s, Mr. Neruter used to tell me in Raiji's firm that in charitable trust, unfortunately, when the people who have to run the charitable trust as well as those who used to write accounts and comply with the law, they are also employed on the basis of charity. And therefore, the competence is not necessarily a criteria, but it is from the heart the decisions were being taken and not from the mind. And that's how the charity, of course, kept on suffering in terms of its administration. So far as FCRA is concerned, I was just yesterday going through the data published by the Home Ministry. In 2011 too, about more than 11,000 crores are received. And out of 11,000 crores, almost 9,000 crores are among the 7 states, of which the 4 states are measured from South India. So all South Indian states, I think, seem to have received the maximum amount out of the collection. There was also an analysis available that in which cities it has come maximum. So out of 11,000 crore, almost 5,000 crore rupees have come only on 4 metros plus Bangalore. That is the statistic source. There is a debate going on as to whether there was a debate, this law should be there or not, because of the way in which it is implemented, the problems it creates. But I think it seems to be in the national interest, at least from the point of view of internal securities. I don't think we have time to get into that at this juncture. But I think Rajesh, of course, would be the best person to introduce this subject and make you familiar with this. In fact, after your hearing, it is possible that we need to give a full day seminar only on FCRA to understand the implications thereof. We would not have got better person than Rajesh for this. For the purpose of a formal introduction, may I request Ganesh to introduce him to the audience. Thank you.
Good afternoon, friends. It's my pleasure and privilege to formally introduce Mr. Rajesh Kadakia. He is a silver medalist chartered accountant. He was partner in SR Batleva and Associates, a member firm of EY Global, and is now part-time senior advisor with EY LLP. He has written a number of books, including Law and Practice of Tax Treaties and Indian Perspective, Master Guide to Income Tax Act, published by Taxman. He is the promoter director of Legatex Online, a company engaged in development of online databases on income tax and other laws. He is the author of Charitable Institutions Referencer, the first online database on taxation of charitable institutions, CSR, Foreign Contribution Regulation Act, etc. Friends, let us all welcome Mr. Rajesh Kadakia. Before we ask Mr. Kadakia to start his address, I request Vice President of Chamber, Mr. Lalwani, to present him a memento as mark of our respect.
all of you. In the next 1 hour or so, I propose to speak on what is the meaning of charitable institution for FCRA, receipts of contributions by institutions when FCRA is applicable, foreign source, a key word in FCRA, and foreign contribution, another key word in FCRA. There is a procedure for registration with central government or a prior permission, and the post-registration, post-prior permission compliances, finally renewal of registration. One of the darkest periods in independent India was from June 1975 to January 1977, when India was under emergency declared by Mrs. Gandhi. Democratic rights were suspended, opposition parties, the leaders were all imprisoned, and so on. And during this period, FCRA 1976 was enacted. The purpose was very clear. Seditious activities were being carried out, anti-national activities were being carried out with funding from foreign sources. Religious conversion was being abated by foreign funds, and that is the reason FCRA was enacted. Version 2 came in 2010, which is the subject for today, FCRA 2010. And it's very interesting to note that the Home Minister, Mr. Chidambaram, at that time, told in the Parliament that India does not need foreign charities. In spite of that, we are continuing. So, broadly, FCRA, I would divide it into two categories: prohibited category and regulated category. So there are certain types of individuals, entities, like political parties, judges, etc., who are absolutely prohibited from getting foreign contribution. And the other category is regulated category, which includes charitable institutions. Charitable institutions are allowed to get foreign contribution provided they have necessary approval. They are regulated in terms of what investments they can make. They are regulated in terms of how the money can be utilized, and they are regulated in terms of the reports that they are required. How do you interpret FCRA? When I started, I was not aware, and ultimately I have found only 5 reported judgments on FCRA. Unlike income tax, where there are 5 judgments every week on charities and ADG. This is governed by Ministry of Home Affairs, unlike income tax, which is the Ministry of Finance. So there is no fiscal motive in it. As Mr. Bhai said, security of the country is important, and hence I would interpret strictly in favor of the government and not try to be a loophole-oriented person. The government has come out with many FAQs, including 40 plus on charitable institutions. It's there on the site, government site. And they are quite important in interpreting FCRA. Rules. This also a rule-oriented act. Rules and forms also play a big role in ultimate interpretation. So, and one very important thing from a charitable institution perspective is that FCRA casts no obligation on the donor. If there is any default, the donor is not penalized. Who is penalized is the recipient. So the charitable institution has to be absolutely guarded and in compliance with FCRA. The donor is, to say the least bothered. What is the meaning of charitable institution for FCRA? And there is no definition, neither charitable institution nor charitable purpose, they are defined. But FCRA essentially applies to a person, and person has been defined as point 3 in the slide. It includes an association, a company registered under section 25, now section 8 of 2013 Act, and it's given in the handout. And an association includes a society, any other organization by whatever name called. So combined reading of both the definitions, in that FCRA applies to all charitable institutions which are persons, that is companies, societies registered under Societies Registration Act, and trusts. So broadly it covers all charitable institutions. When is FCRA applicable to a charitable institution? So two conditions are required to be satisfied. Contribution is to be received from a foreign source as defined, and the contribution is foreign contribution. And these are cumulative conditions. Even if one of the two is not satisfied, then FCRA wouldn't apply. So if there is a foreign source but no foreign contribution, FCRA wouldn't apply. If there is foreign contribution, technically, but not from foreign source, then again FCRA will not apply. So once it applies, what are the conditions for receipt? And it can receive contribution provided two conditions are satisfied. A, it has a definite cultural, economic, educational, religious or social program. And B, it has obtained from central government a certificate of registration or prior permission. So the first condition is definite cultural, economic, religious is also covered program. Now here there are two views on what exactly is the scope of this condition. So if you read the definition and the section for registration, no person having a definite cultural, economic, educational, etc., shall accept. So on a literal reading, only if a person has definite program, that it is required to obtain a certificate. And that is the view taken by some authors also, that unless you have a program, you are not required to get a certificate, registration certificate. Sorry. I would personally believe, with respect, that is not the right view. Although the language does give that impression, but look at the consequences. If you don't have a program, then you are not required to get a registration. You are not required to be regulated. You can invest in whatever form you want. You can utilize in whatever form you want. And you are not required to file the annual return, etc. I would personally believe these consequences are very absurd, that someone, a trust which does not have a program, can do whatever it wants, where a program or where a trust which has some program is regulated. So that's why I felt that it's a condition rather than just the language anomaly. So we go to the important definition, foreign source. And it has many categories, but three are important which I will take up. One is foreign company. So foreign source includes foreign company. It includes a company under Companies Act 1956, now 2013, with more than 50% of nominal value of share capital held singly or in the aggregate by one or more. And the last category is important, foreign companies. So an Indian company with more than 50% of nominal value of share capital held by one or more of foreign companies is also a foreign source. Mind well, an Indian company. And the third is citizen of a foreign country. So these are the three important categories which constitute foreign source. And then what is foreign company? Again, two important. It means any company incorporated outside India and includes a foreign company within the meaning of 591 of Companies Act, or a company which is a subsidiary of foreign company. So any company incorporated outside India and a company which is a subsidiary of a foreign company. And this creates a little interesting situation. The second category, small Roman 2, a company which is a subsidiary of a foreign company. So what is the definition of foreign company? Foreign company, the same definition will apply. So it will include a subsidiary. So a subsidiary of a foreign company is a foreign company, and then that's why its own subsidiary will again become a foreign company, and that's why the subsidiary will also become a foreign company. I'm not sure whether that was intended, but this is the result of the language. So how do we analyze it? One is that the definition is inclusive. So apart from the categories mentioned, if there is any category which constitutes a foreign source in the ordinary sense of the word foreign source, will also be covered. And that is what Delhi High Court also upheld. And then I have listed a few categories, and let's see whether they are foreign source or not. NRI. If you see this, NRI is an Indian passport holder. He is not a citizen of foreign country, and that's why an NRI is not a foreign source. This is also confirmed in the FAQ that NRI is not a foreign source, someone who holds Indian passport, who is an Indian citizen. Only one word of caution. The FAQ provides that it's not a foreign source, and the contribution by an NRI is not a foreign source, provided the money comes through normal banking channels and out of the savings of the NRI. So these two conditions, according to the FAQ, have to be satisfied. I would personally believe that's a more prudent approach rather than going full hog and claiming that any contribution by an NRI is foreign contribution. I would feel one should try to satisfy these two conditions. But take PIO and OCI card holder. They are citizens of foreign country, and that's why they are foreign source. And that is again confirmed by the FAQs. a foreign company owned by NRIs. A foreign company owned by NRIs is actually a foreign company because it's incorporated outside India. And since it is incorporated outside India, it becomes a foreign source. Indian subsidiary of foreign company, as I mentioned, once more than 50% share capital is held by a foreign company, then that Indian subsidiary becomes a foreign source. So to give you an example, if Microsoft India Private Limited, 100% owned by Microsoft, that is a foreign source. Subsidiary of subsidiary, as I explained, under section 287 of Companies Act and under the provisions as I explained, that is also a foreign source. The definition of subsidiary under the Companies Act includes a board controlled subsidiary, and that's why a board controlled subsidiary is also a foreign source. Notwithstanding, the entire capital otherwise could be held by non-foreign source. Foreign 100% subsidiary of Indian company. So let's take Indian Hotels Company Limited. Indian Hotels has a subsidiary outside India. Although it's 100% subsidiary, and although Indian Hotels is not a foreign source, the foreign subsidiary will constitute a foreign source. The next is Indian companies with more than 50% foreign subsidiary. So there are Indian companies, a couple of names that I could find: Britannia, Jet Airways, ICICI, and these are from public domain. They may not be absolutely limited, but they are all Indian companies with more than 50% foreign holding. So very literally and strictly on the basis of the language, they all form foreign source. There is no distinction between listed and unlisted companies, and hence even a listed company in India could constitute a foreign source. And same way with preference capital, because if you see, the language is more than 50% of nominal capital, and this is also the definition of subsidiary in Companies Act 2013. So even if preference share capital constitutes more than 50% of the total capital, and if that capital is held by a foreign company, then the particular company would be rather a foreign source. So the anomaly that happens is NRI not a foreign source, foreign company owned by NRI is a foreign source, Indian company owned by NRI directly is not a foreign source, but Indian company owned by a foreign company owned by NRI again becomes a foreign source. So I think what they had in mind is the formal structure, and rather than the getting or lifting the veil and seeing who are the ultimate owners. We now go to foreign contribution, and there are three categories. Category 1 is the primary contribution. And what are the conditions? A, there is a delivery, transfer or donation. B, such delivery, etc. is made by any foreign source. C, such delivery, etc. is of any article, Indian currency, foreign currency, any security as defined in section 2H of SCRA, and including foreign security as defined in section 2O of FEMA. So these are the three conditions. If they are satisfied, then it becomes a foreign contribution. There is only one exclusion. an article given to a person as a gift for personal use. And this is in the main primary contribution, this exclusion. There are other exclusions which I will come in later. If it's given as a gift for personal use, if the market value of such article in India is not more than prescribed sum, which is 25,000 at this stage. So if a gift for personal use, an article, mind you, this does not apply to currency as such. It's only if it's an article. And if its article is given as a gift for personal use, not exceeding 25,000 market value, then it's not foreign contribution. So question is whether this will apply to charitable institutions. Can a charitable institution have a personal use? In income tax in section 37(1), Gujarat High Court said a company cannot have personal use. But interestingly, under non-tax law, an old 1935 judgment I found Bombay High Court, where they said that when it applies to individuals as well as non-individuals, then personal use should mean something for own use and not for sale. And in that case, it will become personal use for it. And it was in the context of a private limited company. I would believe the same principle would apply to a charitable institution in the context of foreign contribution. So if a small article is received by a charitable institution, even from a foreign source, I would submit it does not become a foreign contribution. The second category, and this is what I call as indirect contribution. Any contribution received from any person who has received it from foreign source, either directly or through one or more persons. And I will revert to it in the next slide. So, contribution received by an individual who in turn received from a foreign source, that also becomes a foreign contribution. And the third category, three classes: interest accrued on foreign contribution deposited in the bank, or any other income derived from the foreign contribution, or interest thereon. So in these three cases also, it will become foreign contribution. So what is, so there is no basic exemption, as we call it, the term known as clause. Technically and literally, even if it's 1,000 rupees, it would be a foreign contribution. Contribution can be in Indian rupees, not necessarily only a foreign currency. It could be in India. There is an FAQ to this effect, and in one of the cases, the bank has confirmed in writing that yes, we would accept that as a foreign contribution, provided sufficient proof is available that it is really from a foreign source. And then the few situations whether following a foreign contribution. So first is donation of land and building. And if you recollect, it has to be a donation of an article, and this is where the controversy is. From income tax perspective, Orissa High Court said that the definition and the meaning of article is wide enough to cover immovable property. It was reversed by Supreme Court, but not on this principle. It was in the context of the entire scheme of that section that Supreme Court reversed it. On the other hand, Calcutta High Court said no, even in its ordinary sense, an article is confined to movable property and not to immovable property. So very difficult decision, and at least I feel it is not intended, even if it is so, because there is no reason why a charitable institution should get a gift of land and building in India and not be subjected to foreign contribution. Donation of old clothes medicines, etc. Article. The precondition is article, and these would all constitute articles. So if Gunj, an NGO, receives clothes from abroad from a philanthropic PIO, then it would be foreign contribution. And the exception for personal use will not apply because this is meant to be given to others. Shares in unlisted companies. This is interesting. What is covered is securities under section 2H of SCRA. And the definition of securities is given in the handout. Securities and other marketable securities. And Supreme Court has interpreted that expression as what is marketable in Bhagwati Developers versus PLS. A security which is not suffering from alienation restrictions under a statute. So, share in a private limited company which is subject to alienation restrictions technically is not a security, certainly not for SCRA, and on this interpretation, not for FCRA also. Again, I am not sure whether this is intended, but this is on the basis of the review. Pro bono services. So suppose a subsidiary of foreign company in India gives free of charge services or gives its premises free of rent to a charitable institution. Is it a foreign contribution? And I would feel no, because services are not article. What is covered is article and not services. But free supply of goods, as I said, example, computers. Those computers would constitute articles, and since they constitute articles, if they are coming from a foreign source, it would be a foreign contribution. So next is a tricky situation. Suppose the market value of goods is 1,000 rupees and the foreign source supplies to a charitable institution at 100 rupees. What happens to the 900? Is it foreign contribution or is it not? Very tricky. I somehow believe it would depend on the facts, the extent, the purpose for which the goods have been received, and the purpose with which the goods have been utilized by the institution. So to give an example, an equipment of 1 crore is given for 500 rupees or 1000 rupees to a charitable institution. Can one really contend that it's not a donation? And mind well, the words used are not only donation, delivery or transfer. So there is a transfer of article, transfer of an equipment, and what may be required is apportionment. Apportionment has been permitted by Supreme Court and other courts in other contexts. So depending on the facts, I would feel whether it's a foreign contribution or not, that will be dependent on that. The last is CSR contribution. So as I said, a subsidiary of a foreign company constitutes a foreign source. It would be covered, Indian subsidiary, would be covered by section 135 of Companies Act. And whether that constitutes a foreign source. And suppose it decides to spend the CSR obligation and discharge it through a charitable institution. What happens? On first glance, yes, it's a contribution. But point for consideration is, section 135 does not call it a contribution. It says a company shall spend 2% of its profits. If you read the rules clearly provide that the company which is required to spend on CSR will have to specify the project. It can do it directly or through a trust, and it will have to specify the project, the program. It will have to specify the modalities of utilization. It will have to specify the monitoring mechanism, and it will also have to specify the reporting mechanism. So sense that one gets is that the trust is only a vehicle or an agent for the company in performing the CSR duties, but it's not really a contribution without any consideration. There is a reciprocal promise. There is an obligation to take back the money if it is not utilized. So in these circumstances, a point for consideration is whether it's really a foreign contribution. We now go to what is indirect contribution. And as I explained, indirect contribution, when the donation comes from a person who in turn has received it as a foreign source through one or more persons. So if A, as I explained, if A receives a gift from his relative in US, that is a foreign source, and if A donates that to a charitable institution, that would be an indirect contribution, it would be a foreign contribution. And there is no limit to the links or the layers, because it says one or more persons or through one person. So if A gives to B, B gives to C, C gives to D, D gives to E, and E gives to a charitable institution, then even that would continue to be a foreign contribution, subject to section 56 if each of them is successively levied with income tax. And it is not restricted to, the first gift need not be, this is important, only to a resident in India. The first gift could be received by an NRI outside India. So if an NRI outside India receives a gift from a PIO outside India, and in turn he gives a gift to a charitable institution, it would not be a foreign source in a normal sense, because NRI is not covered. But since it is not out of his own funds, since he is covered by this deemed that, it could be a foreign contribution. And the last, on secondary contribution, what is the meaning of income derived from any foreign contribution? And there are two aspects in this. What is foreign contribution and what is income derived from such foreign contribution? So as I explained, the first link is interest accrued on a foreign contribution deposited in a bank. So the check that is received is a foreign contribution. The cash that you receive is a foreign contribution. The old clothes that you receive is the foreign contribution. The shares that you receive is the foreign contribution. And if we accept that yes, that is the foreign contribution, then the next question is, what is income derived from foreign contribution? So a simple question that I have is, if that article or share is sold, is it income derived from foreign contribution? In income tax, we have a controversy. Transfer of a capital asset or a transfer per se is not income derived from foreign contribution. There is an old Mumbai High Court decision to the contrary, but generally speaking. Here, FC7, which is the annual return to be filed in respect of dues received under as in kind, very clearly envisages that the sale consideration is also foreign contribution. So irrespective of the stand that one would take in income tax, for FCRA, in view of the form, the sale proceeds also constitute foreign contribution. So if you receive shares, if you receive articles, and if you sell them, the consideration that you receive is foreign contribution, and then the consequences are that it has to be utilized like any other foreign normal contribution. Excluded consideration. So these are the categories which are excluded from what is